Okay, hello. Today we are going to start with our very first episode in corporate finance. So this is the corporate finance introduction series. So in this episode, we are going to discuss that what is corporate finance and why does it matters. So welcome to our corporate finance introduction series. Whether you are a MBA student, a commerce graduate, an aspiring entrepreneur or finance professional, or simply someone interested in understanding how businesses make financial decisions. This series will provide a strong foundation in corporate finance concept. Before we begin discussing investment decision, capital budgeting, valuation technique, risk management, and financial markets, we need to understand a fundamental question. So, what exactly is corporate finance? So, corporate finance is often described as the heart of every business organization because almost every major business decision has a financial impact. When a company decided to launch a new product, acquire another company, construct a manufacturing plant, expand internationally, purchase new technology, hire employees, or raise capital from investors, corporate financial principle guides those decisions. In simple word, corporate finance focuses on how organization makes their money to maximize their wealth and to achieve long-term growth. Today, we will explore the meaning, objective, scope, importance, and major decisions involved in corporate finance. So, first, understand the meaning of corporate finance. Corporate finance refers to the area of finance that deals with the financial activities and the decisions of corporation and a business organization. It focuses on answering three critical questions. Question number one is, where should the company invest its money? Should I go for the missionary A or shall I go for a missionary B? So if I go for that missionary A or B, the cost, the services, the other indirect expenses, employees, labor, skills which are required to operate that particular machinery, all these things are included. And how long it will take for organization to get back their money. This is the first one. Second one is how should the company raise fund? So this is the second one. And third one is how should profit be distributed among the stakeholders? These questions may appear simple, but they determine the success or failure of the business around the world. Around the world. Imagine a company has 100 crores available for investment. Okay, 100 crores. Should it invest in a new factory? Should it develop a new product? Should it purchase advanced technology? Should it expand into foreign market? So, corporate finance provide analytical tools and frameworks to answer these questions scientifically rather than relying on intuition alone. So, next we are going to discuss that why corporate finance exists. So, every business operates with unlimited resources, right? Limited resources. No company has unlimited money, unlimited time, or unlimited opportunity. For example, as I said that I have 100 crores of money for the investment. So I keep that 100 crores money for the investment. Let me go and invest in any product, any machinery, sorry, any plant. Can I wait for 10 years, 20 years, 30 years, 40 years? Whether we don't know whether the company will be available or exist in the competitive market or not. Because of the inflation, because of that GST, because of various factors will affect the business day-to-day activities. So we don't have much time. So management must therefore make careful choice regarding resource allocation. For example, a company may have 10 attractive projects, but enough fund to invest in only three. Choose the right three project can create enormous value for stakeholders. Choosing the wrong project can result in losses and financial distress. Corporate finance help managers identify investment that generate the highest value while minimizing the risk. The ultimate goal of corporate finance. Many people believe that the goal of business is to maximize profit. Right? Profit is important. Modern corporate finance suggested a broad objective, maximizing of shareholders' wealth. The primary objective of corporate finance is to maximize the shareholders' wealth over the long term. So this means increase the market value of the company and enhance the wealth of its owner. Consider two companies. Company A in high profit this year but ignores future sustainability. Company B earn moderate profit today while investing in innovation and future growth. Corporate finance generally favor decisions that create sustainable long-term value rather than the short-term profit. Therefore, financial managers focuses not only on current earnings but also on future cash flow, risk level, and growth opportunities. Very few. It's a simple example that today you are going to invest in mutual fund. Of course, you are going to get your salary. You are going to save that sal money for further investment, or you can plan for any future purchasing of asset or day-to-day activities, monthly expenses. But at the same time, you are going to invest your fund on stock market. Very clear. You are going to invest your fund on stock market. So, for example, monthly you are paying 5,000 rupees as your SIP mutual fund. After 20 years, 30 years, with your existing salary, you can maintain for that regular monthly expenses, daily expenses, have some minimum profit. But at the same time, you also invest your fund on SIP. So after 20 to 30 years, that SIP alone have a huge amount. It's a huge amount. It is a long-term progress. It is a long-term process. It is not only a day process or it only for a year. It is a long-term process. At the time, you can able to plan for a very big investment. It can be a asset. You can go and start a new business, franchising a new business. So whatever it may be. So this is what corporate finance suggests, or it can be implemented in a business, in a successful business. So next we are going to discuss about evaluation of corporate finance. The field of corporate finance has evolved significantly over time. So traditional era in the early years, finance primarily focuses on raising fund. Companies were concerned mainly with obtaining capital from banks and investors. This expansion era, in between era, as business became large and more complex, financial managers began emphasizing investment decision and effective resource allocation. Finally, the modern era, today corporate finance encompasses strategic planning, financial forecasting, risk management. So the risk management is particularly very important because, of course, maximizing the profit is good for organization. At the same time, minimizing the loss is also a smart move of each and every organization. So next one is corporate restructuring, mergers and acquisition, international finance, sustainability consideration, and value creation. Corporate finance has become an integral part of strategic management. So next one is scope of corporate finance. The scope of corporate finance can be divided into several major areas. First one is investment decision. Investment decision involves selecting asset and projects that will generate future returns. Example, purchasing a machinery, building a factories, launching product, acquiring technology, expanding operations. So financial managers analyze expected cost and benefit before making investment decision. This area is often called as capital budgeting. So here, next one is financial decision. After identifying attractive projects, companies need money to finance them. The financing decision concerned determining the best mix of equity capital, debt capital, and retained earnings. And don't worry about all these three elements: equity capital, capital, and retained earnings. We will discuss in detail in our upcoming classes. These are all called capital structural decision. So next, a company may choose a bank loan or bonds, equity shares, venture capital, internal fund. So which one is preferable? Either can I depend only on bank loan or can I go for the bonds, go for the equity shares? It is completely depend on balancing risk and returns. Too much of debt can increase financial risk. I already told you that minimizing the risk is the another form of maximizing the profit. Too little debt may limit growth opportunity. Therefore, managers seek an optimal capital structure. Third one is dividend decision. When a company earns profit, management must decide how much profit should be distributed to the shareholders, retained for the future growth. There is some methodology called instead of giving fund to the shareholders, what organization will do is they will again reinvest the same money in the business. So what will happen is it will create a long-term cash flow for their shareholders. So, for example, if a company earn 100 crore profit, it may pay 40 crores for crore as a dividend, retain is 16 crore for the expansion. Instead of giving that 60 crores to the shareholders, they are going to use that 60 crores for the expansion of the business. So the decision depends on growth opportunity, investor expectations, liquidity position, and future investment plan. And fourth one is working capital management. So business required fund for daily operation. Working capital management focuses on managing cash, inventory, receivables, and payables. Even profitable companies can fail if they cannot manage short-term cash flow effectively. Therefore, maintaining adequate liquidity is a critical responsibility of financial manager. Key stakeholders in corporate finance. So, corporate finance decisions affect multiple stakeholders. So, first one is shareholder. They invest capital and expect the return from the business. Then managers. They make optimal and strategical decision to win in a war. Creditors. Bank and lenders provide debt financing. Of course, they expect the interest amount as well as the actual amount. So when the bank will provide a loan, if they found the organization, the company is potential to pay back the money or not. So when it comes to payback, we will discuss about payback period in the upcoming classes. So next one is employees. Financial decision influence salaries, benefit, and job security. Salary, of course, monthly we will provide. So, what makes the customer to stay in a particular organization for a long time is benefits and job security. These two elements play a vital role in all the business. And next one is customer. So, end of the day, who the organization is going to work. Financial stability affect product quality and service continuity. If there is any lack, the whole business have to face the problem. And government. It receives tax and regulates financial activities. A successful financial management balances the interest of all the stakeholders while creating long-term values. The role of financial manager. So, a financial manager acts as a financial architect of the organization. Their responsibility include planning, investment analysis, fundraising, risk management, performance monitoring, strategic support. Modern financial managers participate actively in organization strategies rather than the maintaining accounts record. So the real world example of corporate finance. Let's come into the first example. A new manufacturing plant. A company planned to establish a new manufacturing facility costing 500 crores. The corporate finance helps determine to understand project feasibility, funding sources, expected return from that particular project, and the risk level. So this is example one. Second example is business acquisition. A corporate wants to acquire a competitor's firm. So many examples are there. Well, organization can invest their fund in our business, or they go and acquire our business. So these happen only after the corporate finance evaluates the potentiality of the business. First one is company valuation, synergize, financing method, expected value creation. So all these four aspects only they will go through completely and then they will acquire a business. So next one is product launch. Before launching a new product, financial managers estimate development cost. Second one is marketing expenses, expected revenue, and the most important thing is break even. How long an organization will take to reach the break even point. These analyses support informed decision making. Now, let's come to the corporate finance and business success. Many successful global corporations own their growth not only the innovative products but also a sound financial decision. Organizations that allocate resources effectively can grow faster, survey in the economical downturn, especially in the year 2026. Right now, we are facing several issues because of war, because of lack of petrol, LPGs, many issues are there. So, how an organization is surveying? Next one is generate high return, attractive investor, maintain competitive advantage. So next one is poor financial decision. However, can lead to cash shortage, excess debt, bankrupt, loss of shareholders' confidence. Therefore, corporate finance serves as a strategic tool for organization success. So, from the next class, in the next video, key concept we will discuss in those series is time value of money, risk and return, capital budgeting, cost of capital, capital structure, dividend, many more we are going to see. So, to summarize, the corporate finance is the discipline that helps organization make financial decisions, aim to maximize shareholder wealth, and ensure sustainable growth. It revolves around three fundamental decisions. Investment decision. Where should the company invest? Next one is financial decision. How should the company raise fund? Either bond or existing money are going to get shareholders fund. Third one is dividend decision. How should profit be distributed? In addition, effective working capital management ensures smooth day-to-day operation. Corporate finance is not merely about numbers. It is making strategical choice that determine the future of the organization. Every expansion plan, acquisition, product launch, funding decision, and growth initiative rely on sound financial principles. As we continue this series, we will gradually build the knowledge and analytical skills required to understand how modern corporations create value and make financial decisions in an increasingly competitive global advantage. Thank you for joining this introduction to corporate finance. In the next episode, we will discuss one of the most important foundation of finance, which is time value of money, and why 1 rupee today is more than 1 rupee tomorrow. So till then, bye from Ananda Balaji.